So, what if you could actually turn political headlines into a real, profitable investment strategy? Today, we're going to dive into some brand new research that uses AI to uncover this hidden force in the stock market, and it's tied directly to populism.
8%. At the heart of all this is a strategy that, believe it or not, has historically cranked out an average annual excess return of 8%. Now that's a pretty big deal, especially because it's not explained by any of the usual risk factors investors look at. So, how on earth is that possible?
And that really gets to the core question here. It turns out that by systematically measuring populist feelings in the media, researchers have actually found a consistent and, profitable pattern in how stocks perform. And it all starts with a very cool new tool.
To find this pattern, you first have to figure out a way to measure something as well as fuzzy as populism. And that's where things get really interesting, using a new tool called the Populism Index, or POP.
The scale of this is just wow. To create the POP Index, they fed a powerful AI more than 1 million articles from the Wall Street Journal, stretching back over 4 decades. And the goal wasn't just to count words, no. It was to truly understand and put a number on the level of populist sentiment in the news over all that time.
So here's the key difference. Older methods, called bag of words, are pretty good, but they basically just count keywords. The problem is, context is everything, right? Think about the word elite. Is it talking about a political class or an elite quarterback? Big difference. The new AI method, it gets that. It understands the context, which means it can spot new themes a simple word count would just fly right past.
And this is exactly why that context matters so much. You might be thinking, oh, so they just count phrases like "Make America Great Again"? But actually, nope. The research shows that those famous catchphrases barely move the needle on the final result. The real signal comes from the AI's much deeper, more subtle understanding of the language.
Okay, so we have a way to measure populism. Awesome. But how in the world do you turn that into an 8% return? Well, let's get into the strategy behind what they call the POP premium.
The main idea you need to get is something called POP beta. Look, you know how a normal beta measures how much a stock moves with the overall market? Well, POP beta is the same idea, but it measures how much a stock's price reacts when the populism index heats up or cools down. Simple as that.
And the strategy itself? It's surprisingly simple. First, you calculate the POP beta for every stock you can. Then, you buy a bunch of stocks that are the least sensitive to populism, the ones with the lowest POP beta. At the exact same time, you short or bet against the stocks that are the most sensitive. And that's the whole play.
And the result of doing this is pretty incredible. A single dollar put into this strategy back in 1986 would have grown to over $31 by 2024. And that's even after you adjust for all the standard market risk factors. Just wild.
Now look, whenever you hear about a new market-beating strategy, you should be skeptical. I know I am. And the researchers knew people would have 2 big questions right off the bat, so they put their own findings to the test.
The first big question is obvious. Is this just a Trump thing? I mean, is this whole premium something that only popped up in the last few years?
The data here is crystal clear. The answer is a hard no. When the researchers split their data right at 2017, the POP premium was there, positive and significant, both before and after. So investors were pricing this risk long before it was a front-page headline every day.
Okay, so the second big question is about the elephant in the room, big tech. We all know populism has risen at the same time as these giant tech companies. So, is this strategy just a clever backdoor way to bet against the Magnificent Seven?
And again, the answer is a decisive no. The researchers literally took the 7 biggest US tech firms completely out of their data and reran everything. The result? The 8% POP premium stayed pretty much exactly the same. So this is not a tech story, it's something way broader.
So if the premium is real, it's been around for a while, and it's not about tech, then why does it even exist? What's the economic logic here? Why would investors get paid for this?
And here's the twist. And it's a little counterintuitive. The premium isn't a reward for being safe. It's actually payment for taking on a very specific kind of risk. Those low beta firms, the ones you buy in this strategy, they're often these huge global companies. You know, the kind that can become targets of populist policies. So they actually get riskier when populist sentiment is high. That 8% premium, that's the paycheck investors demand for being willing to hold that risk.
All right, we've gone through a lot of ground here. The data, the strategy, the why.
So what are the main things you should walk away with? Let's just recap real quick. We've seen that a new AI index can actually measure populist sentiment in the news. This index has uncovered this hidden 8% annual premium. The strategy is all about buying firms with low sensitivity to populism and shorting firms with high sensitivity. And we've seen this premium is robust, it's not new, it's not a tech thing, and it's basically a reward for taking on a very specific type of political risk.
And all of this leaves us with one final, and I think really provocative thought. This shows that these huge AI models can go way beyond just counting keywords. They can understand the deep stories driving our economy. So if this tech can find a hidden premium tied to populism, just imagine what other economic forces, what other risks and rewards are out there right now, just buried in mountains of data waiting to be discovered next.